Well, Dan, it's a pleasure to be here, and it's an honor to be on this terrific panel. Before we start, I just want to take a little bit of pride in having Dan as a former student. I'm delighted to be here to celebrate his success. And I think it may be true that I suggested one of your early insurance topics on contingent commissions. I said it's a great...
Absolutely correct, yes.
I think I maybe didn't mention it was insurance. I thought that might scare him off, but it was a great idea. And he wrote a great article, and the rest is history. I mean, I have to say, I have a case book where it's sort of embarrassing now because the section on insurance regulation is almost all excerpts from Dan's articles, and I kind of feel like I owe him royalties now for all the work he's done over the last 10 years. But this is, as I said, a really interesting panel that Dan has put together, and it's another tribute to him. You know, on the academic side, we have Martin Grace right next to me, who's now at Temple University, who's been one of the leading scholars for many years on the economics of insurance regulation, to which he'll speak in a moment. My good friend, Pat McCoy, the other academic, or the third academic on the panel, is the Liberty Mutual Professor of Law at BC. She was, as many of you know, but I always like to say, one of the most prescient writers about the subprime crisis well before any of us knew that AIG had a CD book in London that might be an issue. She recognized systemic risk on the horizon, and she's going to speak a little bit to that later on in the panel, but it's great to have her here. On the regulatory side, I have to say, once Roy has represented FSOC, and I think you still can. It lasts for at least a couple weeks after you're off. We just have the trifecta of what you would want in terms of the other areas of regulation here today. Ted Nickel was former president of the NAIC and the commissioner of the Wisconsin Insurance Department is here. Mike McRaith, who is now with Blackstone, but he was the director of the FIO, as you heard from Roy, and before that at the Illinois Department of Insurance Regulation, where I think actually you worked on contingent commissions too. You investigated. I don't know if you read Dan's article or if Dan read your investigation, but you had an overlap there.
Of course I read Dan's article.
That is the right answer. So that's a wonderful connection, and of course we have Tom Sullivan from the Fed, who is, as Roy mentioned, the point person there on regulatory matters, and I'm very much looking forward to what he's going to have to say. This is actually a really interesting time to be talking about state-federal relations in insurance. If we had been here 10 years ago, as Roy kind of mentioned, we would have been talking about the federal charter, and you know that was going to be the rise of new authority. And if we'd been here maybe 2 or 3 or 4 years ago, we would have been in a world where future FSOC designations would have seemed likely, probable. The Fed's authority over holding companies with some sort of depository institution was going to be dominant, and the Fed as a major player would have been, likely the future. And of course, now that seems very, very distant. Federal charters, I still think about it occasionally, but it's been really off the agenda for a decade. The designation process is now down to Prue, and I'm predicting 0 if we get together in another year. But I think Roy's certainly right that we're not adding there. And it's a really interesting question that Tom I think will speak to about what the Fed's role is going to be. It has this capacity for consolidated supervision. And it also has capital standards that are kind of well-developed, and how they might be applied to groups that have insurance companies is kind of an interesting question. But it's unclear whether that's going to come from the Fed or whether that's going to come at the state level from some of the initiatives that were being alluded to. So that's kind of in play. And, you know, this international role, which I hope we'll have a chance to talk about as part of the federal picture, and the FIO who's in the room when Roy's out of the room at these things, it's quite interesting, the covered agreements that have been worked out for reinsurance and group oversight, and what that role is going to be, and, you know, how strong the FIO and the federal government's going to be in the covered agreements is something that I think we should definitely be taking up and will. I should point out that there's another piece of federal-state interaction that I hope they'll take up on this panel, and I hope Ted maybe will say something about this. But another federal government foray into insurance has been in the healthcare space with the ACA. And again, if we were back here, you know, 4 or 5 years ago, you might have sort of had a view that, well, gee, with Social Security and Medicare and the ACA and CHIPS and other things, the federal government really is taking over large parts of the insurance industry. And I should say the biggest insurance program in the United States is Social Security. So the federal government is in the insurance business in a big way. But on the dimension of health insurance, the ACA is in an interesting place now, where the act remains, but there's a lot of regulatory latitude that's pulling back on the mandates, that's opening up space for state variation, also true on the Medicaid side. So you are looking at a world where the state's role in healthcare, I think, will be much more substantial in the coming years than we might have anticipated, certainly back in 2010 or 2012. So this is a great time. To me, it's kind of looking like a bimodal space where there's still some stuff going on besides Social Security at the federal level, but how much that's going to be is what we're going to talk about. But there's a very big piece that's still at the state level, and I don't see any prospects for convergence. I think there's going to be this bimodal system of regulation, which is a great thing for our panel to talk about. So I think that, you know, maybe I would suggest, since, Pat, you have views on this, that maybe we'll start with the SIFI designation discussion, and then maybe, Tom, we can jump over to how it looks at the Fed side, and, you know, what the role is going to be, just to get us going. But Pat, let me turn it over to you.
Very good, Helen. Thank you for your kind words. Today, as Howell mentioned, I would like to examine one aspect of the non-bank SIFI designation process, which, as we know, under the Obama administration, did alter the balance of regulation between the federal government and the states in important ways. Now, to some extent, that is starting to ebb, but it's certainly not completely gone away yet. It's actually really sort of astonishing to think that it's been 8 years since Congress passed Dodd-Frank and authorized this designation process. And now I would say that the non-bank SIFI designation process is on life support. No new non-bank SIFI designations can happen without the Treasury Secretary's vote. In effect, the Treasury Secretary can exercise a veto. My understanding is that Secretary Mnuchin has publicly stated that he does not plan to vote for any new non-bank SIFI designations in the future. Now, categorically, he has stated publicly that he does not want to get rid of the process, but he doesn't contemplate any individual companies being designated in the future. Then, of the 3 insurers that were designated so far, as we know, the court overturned MetLife's designation, FSOC rescinded AIG's designation and query whether Prudential is next. Today, however, I'm going to talk about a different blow to the non-bank designation process, one that is less well recognized. And this involves the analytical methodology used by FSOC for non-bank SIFI designations. Now, Roy had discussion of a different part of that methodology. I totally agree with Roy's comments in that respect, and I think they need to be taken very seriously. I will be focusing on a different aspect of the methodology. First, let me just very quickly give some background. Dodd-Frank allows SIFI designations for non-banks only on either one of two grounds. The first ground is where material financial distress at a non-bank financial firm could threaten financial stability of the United States. So far, FSOC has only invoked this first ground as the basis for SIFI designations. Now, we all know that most insurance company insolvencies do not threaten systemic risk, do not remotely threaten systemic risk. And so when we're talking about SIFI designations, we've got to make a really important distinction. There are two types of insurance company solvencies. There are the normal, run-of-the-mill insolvencies that I'm going to call idiosyncratic insolvencies. These do not trigger financial contagion. But in rare circumstances, there's a second type of insolvency, which is a systemic insolvency. And these are the rare insolvencies that can, and we saw with AIG, do result in financial contagion. So the question is, what distinguishes one from the other? What distinguishes an idiosyncratic failure from a systemic one? And I'd like to put forward two answers to that. First of all, no company will ever pose a systemic failure unless at the time of its insolvency, the larger financial system is on the ropes to begin with. And of course, that's what we saw in the fall of 2008. The entire system was weakened. And so the other companies that were affected didn't have the capital to withstand the effects. But we also, within the insurer or other company, we need to find channels through which contagion could be transmitted. FSOC has identified 3 transmission channels. I'm only going to focus on 2. The first one is what I call the exposure channel, and this is where a firm suddenly defaults on major obligations and wipes out the capital of major counterparties. Generally, this only happens where an insurer's balance sheet pairs long-term assets with short-term liabilities that are payable on demand, that look bank-like, demand liabilities. The company then becomes vulnerable to runs that can approximate a bank run because the assets cannot be easily liquidated if the creditors demand repayment at once. This is not very common in insurance, and all of us know that in this room, but where I think Dan's call for intellectual honesty in this debate is really crucial is that given financial innovation in the past few decades, there are some companies that have expanded into financial innovations that do create this risk. Dan has done a brilliant analysis of different types of innovations that we do find on some companies' balance sheets. I think it's really, really important to recognize that depending on the company, it can happen, that there is no insurance exceptionalism that makes the field completely out of bounds for non-bank SIFI designations. The other channel of contagion is the asset liquidation channel. And here, contagion can spread where an insurer has to dump assets to raise cash. If its positions are large enough, the fire sales can push down prices for those asset classes and jeopardize other firms with the same holdings. And obviously, we all lived through that in 2008. This is a special concern in insurance because portfolio restrictions cause insurance companies to clump in certain asset classes. And so it's something that we need to be sensitive to. So if I can finally warm to my subject, what methodologies did FSOC use in the insurer designations to analyze the threat of contagion? It used two primary methodologies, both of which were totally appropriate. First of all, it used what I call structural analysis. So it analyzed the balance sheets of Prudential and AIG and MetLife for the presence of asset classes and liabilities that were conducive to contagion in the ways that I've just described. Another form of structural analysis was looking at the structures of institutions. Here, FSOC asked whether existing institutions and regulatory schemes were enough alone to contain the risk of contagion without FSOC getting involved. No reason for FSOC to get involved if existing regulation was sufficient. And so, as we all know, FSOC in particular analyzed the ability of state insurance regulation to contain systemic risk. Now, the other methodology is what types of statistics did FSOC use? FSOC used what we call descriptive statistics. These are really simple statistics. They don't require fancy computerized computer models to quantify the sizes of potential sources of contagion within Prudential, MetLife, and AIG. And they ran all sorts of different statistics: portfolio sizes, leverage ratios, liquidity ratios, size of counterparty exposures, lots and lots of things. So why are these methodologies under attack? In the MetLife case, the district court primarily overturned the MetLife decision on grounds that these two methodologies were inadequate. Not to say that they were inappropriate, but that FSOC needed to use a third methodology. And what was that third methodology? The FSOC said that, the district court said that FSOC should have used a much more powerful and sophisticated statistical analysis, multivariate regression analysis, to estimate the likelihood of MetLife's material financial distress. So the question I want to raise is that even possible for FSOC to do? It's certainly possible to use regression analyses to analyze the risk of idiosyncratic failures. But I maintain that it's not possible to use it to estimate the risk of a systemic failure of an insurer. And the major reason that I want to put forward for that is that you can only have a systemic failure where the larger financial system itself is weakened. And so to predict through multivariate regression analysis the risk of a systemic failure of MetLife requires also estimating the likelihood that the larger financial system will be on the ropes. Multivariate regression analysis can't do that. Why? We know, I think most of us have looked at studies with regression analyses. And what we look for when they produce results are, what is the level of confidence? Do we have 99% confidence in the result? Do we have 95? Do we have some high degree of confidence? To have a high degree of confidence, you need to have a large enough sample size, and then you have to have a set of variables that fits within that sample size so you can have a high enough confidence level. Well, we have a real problem with systemic failures, because in non-bank systemic failures, we can count them on the fingers of one hand. Sample size is way too small. And the number of reasons why the financial system could be on the ropes over, not just today, but over the next 10 years, 20 years, is practically infinite. So we could run a regression analysis, but we'd have no confidence in the results. The confidence level might be 5% or 0% or 1%, but it's not going to be 95. It's not going to be 99. So it's basically, the court was asking the impossible. It was asking the impossible. And because that is now enshrined in the court's decision, and Secretary Mnuchin has stated publicly that he agrees with the court's decision about the proper methodology, we can't do non-bank SIFI designations anymore if that's the requirement. We just can't do them. I think that's a terribly wrong outcome, because this is a space where inherently we are regulating under circumstances of uncertainty. And we can only use the best tools at our disposal. We have to make educated guesses. But to essentially put FSOC in the position that it cannot act, it simply cannot act because the methodology it's supposed to use is impossible to use in this situation, puts us in perilous danger. The last thing I'd like to say, and this is going to be very controversial on our panel, is as a result, systemic risk oversight of insurers has now effectively been relegated to the states. There are many strengths of state insurance regulation, but I do worry that the states are not up to the task for structural reasons. They lacked the information, and they lacked the jurisdiction to carry out systemic risk regulation properly. Under the Model Holding Company Act, Dan and I've pored over this act. The states have only extremely limited jurisdiction, legal jurisdiction over the holding company, and they lack jurisdiction, except in very tiny respects, over any affiliate within the insurance conglomerate that's a depository institution or a broker-dealer. The states lack comprehensive data about counterparty exposures throughout the system, and that's one of the reasons in 2008 with Lehman Brothers that the Federal Reserve is flying blind. At the time, it lacked that information too, but now it has it. Federal government has it, but the states do not. And then finally, state regulation does a wonderful job focusing on policyholder protection, but its mission is not to prevent the spread of contagion throughout the rest of the financial system, and particularly to companies that are not insurers. So I leave you with what I think are sobering thoughts, and I'm sure we'll have a lively discussion about that. Thank you.
Thank you. So Tom, since there was an allusion to your work, maybe I'll pass it off to you now.
Thank you. By the way, I'm completely depressed now, so start with that. But Tom, go ahead.
Why am I, there we go. There we go. Okay. Thank you. It's a real honor and privilege to be with you this morning and to share the dais with some folks I consider to be friends. And I would tell you that the legal scholarly community is important to me as a practitioner. For those of you who might know, when I first started my journey at the Fed, we opened our doors and went on a listening tour, and we did reach out to many in academia. So the work that many of you do is not lost on us when we have to use it practically. And I have history with a bunch of the folks here today. Dr. McCoy's best work was done when she was the chair of the Insurance Law Institute at the University of Connecticut. And for those of you who don't know, I'm a Connecticut native, and I don't live in the swamp. I still live in Connecticut, even though I happen to work here in D.C. I'll be going home tonight. Ted and I served together as commissioners at the end of my tenure when I was the Connecticut State Insurance Commissioner during the financial crisis. My tenure was 07 to 11, so I had a rocking 4 years leading the second largest DOI in the nation. But Ted and I overlapped at the end of my tenure and the beginning of his, so we've known each other for a long time now. And I'd be remiss if I didn't acknowledge the great one, Mr. McRaith, who's graced us with his presence this morning. You see, this is uncharacteristic for Mike to be a little tardy to an event like this. You've probably never seen this before, but we're glad to have Mike here. Mike and I have lots of history. We go back to my tenure as Connecticut Commissioner and his as the Illinois Director, overlapped one another. And it's been said that during our debates at the NAIC, it kind of looked like Lincoln and Douglas. And I would point out to you, Mike, that I know Lincoln, that was an Illinois event, and that Lincoln was the Republican in those debates. And he did come out on top, too, I think. So anyway, I digress. One last point of personal privilege. I'd be very remiss if I didn't acknowledge Roy Whittle. For those of you, or any of you who've ever served in public service and know that it's a high and noble calling, Roy's done it a number of times. And the thought of him hanging him up, if you will, is a loss to those of us in the regulatory community. So thank you for all your hard work over the years, Roy. Okay, now on to the audiovisual parts of the program. Yeah. I have to do one more thing that neither Roy nor Mike have to do anymore. I have to premise my comments today by saying that any of my comments today are mine personally and do not represent the opinions of the Board of Governors of the Federal Reserve or any individual governor at the Fed. So I do have a lawyer in the room who made sure I said that this morning. So now we've gotten that out of the way. The Fed's newfound, and it is newfound, emergence as a direct supervisor in insurance is a relatively contemporary event, which largely comes with the advent of Dodd-Frank and expanded authorities that we received therein. But I would point out that the Fed has never lobbied Congress for increased oversight of insurance. We've never, as an institution, said, we want a piece of the insurance industry. In fact, our authorities that have come to us by virtue of failures or gaps in prior or existing regulatory regimes. So, again, for the record, I was appointed by a Republican governor, so we'll get that out of the way. But I do consider myself to deeply honor the rights of the states. But I also, through my time and tenure, have become very respectful of what the limitations of states' authority are and where the Fed can play a complementary role. Our role is that as a consolidated, operative word, consolidated supervisor of insurance groups, and we complement the states. We supervise insurance groups rather than insurance legal entities, and we do rely on the DOIs for examination of the insurance entities while always seeking ways to minimize burden. We currently supervise 2 cohorts of insurers by virtue of those Dodd-Frank authorities. The first, as Dr. McCoy touched on, is the a more revealing one, which is the designation of insurance SIFIs by the FSOC. And I would point out that we, the Fed, are a regulator. I only regulate them, I don't designate them. The FSOC, and while we have one seat on the FSOC Council, my role and mission and mandate is to regulate the firms handed to us by the FSOC. The second cohort of firms are those firms who have chosen, operative word, no one had a gun to their head that says, you must own a bank. These firms have voluntarily chosen to own a federally, another operative word, federally insured depository institution. So what Dodd-Frank did and said is, with its transfer authority under Title III, with the now defunct Office of Thrift Supervision, sometimes referred to as the regulator of least resistance, those authorities under the HOLA were transferred over to the Fed to supervise those groups. So those are our two cohorts. Collectively, that's only 12 firms, but it represents, either on an assets or premium basis, roughly a fifth or 20% of the insurance business in the U.S. So while I consider the Fed to be a small player, I also consider us to have a significant role in influencing how firms get supervised. Just to give you a little view into while that's only 12 in number, the 12 are very diverse and heterogeneous. They range in size from $3 billion in assets to $800 billion in assets. There are mostly domestic firms, but there are some that have international exposures. There is a predominance of mutuals in the group, but there are some public companies. Some file GAAP financial statements, and some exclusively only file statutory accounting financial statements, SAP filings. A central theme of our discharging our authority under the law has been, since I came on the scene nearly 4 years ago, is to tailor our approach to insurance. It is true that you could have accused the Fed of being very bank-centric. That was a past tense statement. I don't believe, as I sit here today, that we are bank-centric. We have room to grow, right? But I would submit to you that we made, in a short period of time, when you think about it, in terms of standing up regulatory authority, we have pivoted to the point where we do supervise insurance, the business of insurance, like the business of insurance and not like a bank. We don't, and to that end, we don't regulate specific insurance products or the insurance marketplace themselves. Again, we are a consolidated supervisor. And I would, just to be clear here, I actually believe the line, if you will, as specified under McCarran, is arguably brighter today by virtue of the limited authority that was effectively assigned to the Fed than what it was prior to the advent of Dodd-Frank. I would argue that the line is brighter today around what the state's authorities are or are not under McCarran. So I'm going to focus now the remainder of my remarks on that second cohort, the insurance, savings, and loan holding companies, or the owners of banks. Dr. McCoy did such a fabulous job talking about SIFI. I don't feel that I have to talk about that any further, but there's some contemporary events happening with regard to the second cohort that I think are worthy of some discussion this morning. Underpinning the board's supervisory approach to insurance thrift holding companies is the board's belief that it is important that any company that owns and operates an insured, operative word, insured depository institution be held to the appropriate standards of capitalization, liquidity, and risk management consistent with principles of safety and soundness. Today, as we sit here, there is disturbing legislation pending currently before the House. It is known as the State Insurance Regulation Preservation Act, H.R. 5059. And the bill's name really does it no justice, for it would create nothing more than an end around the protections which are in place to ensure federally insured banks all play by the same rules and not create a loophole or an arbitrage opportunity for a certain subset of owners of thrifts. The Fed's supervision of insurance thrift holding companies is tailored based on the size, complexity, and risk profile of insurance holding companies and its depository and non-depository subsidiaries. To that end, the smaller the exposure of the thrift to the non-regulated activities of parent, the fewer resources the board employs and the lower intensity of our supervision. Recognizing that the insurance industry is also regulated by the state DOIs, the board's supervisory emphasis is placed on enterprise-wide risk management activities and the unregulated activities of the firm. To maximize efficiency and to minimize supervisory duplication or layering, the board relies on the work and supervisory findings of the state DOIs and other functional regulators within the insurance thrift holding company structure. Federal Reserve personnel and supervisors regularly meet and share supervisory information and collaborate directly with the state DOIs. The Fed's role as a consolidated supervisor of insurance thrift holding companies encompasses protecting the depositors and the taxpayer-backed deposit insurance fund, a dimension of supervision that any institution accepts when it benefits from federal deposit insurance. It's incongruous to us to privilege insurers that enjoy this benefit over other financial and non-financial firms that own or could pose a risk to subsidiary depository institutions simply on the premise that they are insurers and functionally supervised by the state DOIs. The federal and state supervisory roles and responsibilities are very different, where the state DOIs are not statutorily responsible for safeguarding federally insured subsidiaries of state-regulated insurers. And indeed, I would submit that the state DOIs are actually conflicted here because they are mandated under state law to impede those very same regulated insurers from serving as a source of strength to the subsidiary bank, placing an even greater reliance upon the federal safety net. So if you're a state insurance commissioner, you're mandated to protect policyholders, not to protect the bank. If you don't do that, you're not carrying out your own obligations under your state law. So there's a direct conflict here in this legislation. We see important and essential advantages to streamlining our examinations and our supervisory guidance applicable to insurance thrift holding companies by using a framework that is tailored to the activities and risks, business risks of insurance. We equally see the value in continuing to consult with the state DOI so as to ensure the Fed's supervision does not conflict or duplicate these requirements. But dual-track supervisory framework with a role played by the Fed and state authorities is essential when taxpayer dollars are at risk. It would appear that in the absence of such a dual-track supervisory architecture, insurance thrift holding companies would be permitted to take advantage of taxpayer-backed federal safety net without the standard regulatory supervisory oversight of a consolidated firm that goes along with owning a bank. It should not seem a far-stretched proposition that other institutions supervised by the board, for instance, owners of thrift holding companies like broker-dealers that have their own functional supervisors, or other thrift holding companies more generally, or even a bank holding company for that matter, large or small, who may try to take advantage of a regime designed that relied solely on state DOI supervision of the insurance thrift holding companies without federal consolidated supervision. I'm reminded of the testimony of my good friend here, Professor Schwarcz, about a month ago when he testified on this particular legislation, where he pointed out that in the bill, proposing to eliminate or severely eliminate the Fed's supervisory examination authority is highly prone to the kind of arbitrage I've described. Indeed, the bill has 3 independent paths for a firm to achieve the status of an insurance saving loan holding company exempt from Fed supervision. One where the path is simply to have an insurance underwriting company as its top-tier parent. We could see a fairly simple transaction where one could take a non-insurance institution currently supervised by the Fed to acquire an operating insurer and restructure itself so that it's atop the remainder of the institution. I would not advise this, but nor would I advise enshrining a loophole such as prescribed in H.R. 5059 into law. This bill happens to have other fatal flaws that I would consider equally dark. By leaving the Fed with a post facto capital intervention trigger as essentially its only supervisory tool, it eliminates the important role that holistic supervisory examination plays in providing early warning signs in the times when a recovery is more readily achievable. We effectively would be acting after trouble and crisis has already occurred. The bill carves out a role for the Fed to supervise certain material subsidiaries, but presumably this meant to capture subsidiaries like the certain famous derivatives trading entities that featured prominently in the perilous time of 07 to 09 and in the midst of the financial crisis. But the bill narrowly defines the remit of these subsidiaries, leaving them unsupervised even for the few entities that make it into this category. And it largely restricts the Fed to supervising those subsidiaries using only a balance sheet and an income statement. One need only consider trying to supervise the infamous AIG financial products on the basis of these 2 documents. And you can see how the bill's prone to these kinds of threats to safety and soundness and systemic stability. So I'll close by saying in supervising insurance institutions, the Federal Reserve thus aims to understand the supervised institutions in its remit, their unique risks, and to tailor our supervision to the institution's risk profile and complexity so as best to achieve the board's statutory and regulatory objectives. We've never sought to expand our authority. We don't seek to expand it any more than what we have right now. On the other hand, I would offer to you that we need to be very careful not to carve out loopholes and create opportunities for regulatory arbitrage, because we all know how disastrous that can be. Thank you.
Thank you, Tom. So I'm a little worried about Ted's depression mounting, but before we come back to that, I'd just like to have Martin talk a little bit about the economics and structure of insurance regulation and what makes sense from an economics perspective at a state level versus a federal level, and also maybe at an international level, because I definitely think that we should be getting into that, and I'm sure Michael has something to say about the international piece that we'll get to in a moment. But let me just turn to Martin right now. 10, yeah.
Thank you, Hal. I would like to thank the ALI for putting this conference on. It's great. I want to congratulate Dan on winning his major award. So picture this. It's the late 1800s. I think it was a Tuesday. Somebody from New York tried to sell an insurance policy to somebody in Virginia, and we don't even remember the name of the policy owner, but we're still talking about that same event. It's been a long time, and we've had a number of different diversions all the way through history, coming till today. We can think of, the McCarran-Ferguson Act as a major change in the Southeastern Underwriters case, but then the major change came just quickly after that with McCarran. But since McCarran was passed, we've had a number of progressively differential, I guess you might want to put it, attempts to restructure regulation between the states and the federal government. And at certain times, we were talking about before, I think 10 years ago, around this time, we were at the AEI having a conference on this exact topic of optional federal chartering. I thought it was going to happen. The Treasury had a blueprint, and it was a done deal. And then we had a financial crisis, which took that off the table. But if we look at sort of how an economist would think about optimal regulation of an insurer, if you will, the way we think about it is we try to put the regulatory jurisdiction at the level where the benefits and the costs of regulations can be ascribed to almost completely to that level. So something that is purely state, it would be like state rate regulation, for example. That would be something up to the state because it only really affects the state. While something from an international point of view, like capital standards, that would be has an externality that goes worldwide, and perhaps the regulation should be at some sort of international level. So there's a number of different ways of thinking about that. But the way insurance regulation has evolved in the United States in the last 60 or 70 years, it's not really like that at all. During the optimal federal chartering phase, I guess, we were all talking about this, and we added another element to it, is that insurers could choose which regulator they wanted. And we all sort of know the chance of choosing what did you call it, the least effective regulator, or the regulator of least resistance. That could possibly happen too. So and this is game theory. How are we going to do this to make our board of directors most happy? So there's been a lot of work on these topics. Some people have done research that looking at state regulation, they found that even among the states, some states leave it to New York or to California to really regulate their companies. So like if I don't want to name a state, but let's say Wyoming, you have relatively small regulatory resources devoted to insurance regulation in Wyoming because there's not very many people in Wyoming, so you don't need a lot of big, New York-style regulation. But a New York company to a Wyoming regulator is going to be taken care of by New York for the most part. So we already have this sort of shifting within the states to begin with. Now, if we look at, I guess I know that Baird is here. I found one of his congressional research reports, and there's 11 or 12, there he is. There's 11 or 12 bills in some stage in Congress right now, ranging from, international capital standards to I really hate the FIO Act of 2017, and there's another one that's I really hate it more than you hate it Act. So we're not really, when we look at the bills, we're not really looking at sort of a federal versus a state regulatory scenario anymore. What I think has happened is that I think it really kind of started when Representative Dingell issued his report in 1992 or something, and he embarrassed state regulators. Maybe they weren't embarrassed, but if I read that report, I would think it would be a very critical report of state regulation. And to their credit, they changed a number of things, and they're still trying to do it better. But what happened is that we have not federal regulation in the classic sense, like the Federal Communications Commission or something like that. What we have is federal regulation that's really a shadow regulation. So the states are, doing what they do, but they know realistically that if something bad happens, the federal government is either going to embarrass them again or take it over. So they have an incentive, a strong incentive, to get it right. During the risk-based capital phase. They did something that was pretty innovative around the world to focus on building up the technology and the regulatory authority to deal with solvency regulation. And they've had a number of initiatives going forward to do that same thing. So the way I think about regulation today, federal state regulation, is that it's really about regulation, sort of a passive, aggressive federal regulation and a relatively active state regulation. But we still have a number of issues, what you were talking about just a moment ago. And these issues are really ones of relatively large externalities, or the possibility of relatively large externalities. And so a systemic risk would be a perfect example of that. And the way regulation is being designed, so there may be a federal role, but it's not a large federal role. It is a pointed federal role. The states still have a great deal of authority, but when something occurs that would have an effect outside their jurisdiction, we almost always need to have, I say this almost always, it would be nice to have someone else who has the concurrent jurisdiction to affect a good public policy outcome. That's not always true, but it's something that, because of this externality, we would hope that the federal government could internalize those costs. Now, in addition to the federal government's shadow regulation role, we also have, non-government entities' shadow regulation role. And, the states don't really have the ability to deal with that. So as part of Dodd-Frank, we got our federal insurance office, and we got sort of a unified method for getting consensus to deal with international trade issues and international regulatory issues involving the insurance industry. I have a colleague from Georgia State for years he worked on the WTO when it was first out, and he worked on insurance services. And I think, it took 40 years for that to happen. It is a massive achievement, I think, for the United States to have the ability to talk internationally with one, I guess it's one voice with 51 or 56 people standing behind it. But it is not federal regulation in the classic sense, and it's not state regulation in the classic sense. So I kind of think about that the typical model of federal regulation, if it's interstate commerce, it's federal, as long as you have enough employees involved. But insurance has always been very, very different. And so I think the model going forward is not going to be, the federal government or the Federal Reserve Board or the Federal Insurance Regulatory Commission. I think it's going to be this very parsed regulatory authority between the states for very, I want to call it parochial, not meaning backward-looking, but sort of local issues, the federal government for solvency and systemic solvency issues, and the non-governmental entities around the world who also have an interest in this. They will be parsing regulatory authority among all of these. So I think it's like a milkshake. You have a vanilla milk shake, and then you put some chocolate in it, and it swirls a little bit, and you put some cherry or strawberry in it. You have I don't know what to call it, but it looks like a mess unless it's a milkshake, and then it tastes great. But the regulatory authority here is going to be spread out, and there's going to be, as I was listening to Thomas talking about this, I'm thinking, well, the Fed is trying to get very, very narrow, direct regulatory control. That still has a lot of problems. And it's still very costly to deal with a number of regulators. So there's always going to be pressure by the companies to avoid that. And they may not think of it the way you're thinking of, which is kind of more macro. They're thinking it from a, I guess in this case, a parochial point of view. So the multiple regulators, there's economics of this too, is not a bad thing because they're basically watching each other. And there's a little bit of jostling for attention and power, but it can work. And I think, because we're never going to have the federal government completely out of insurance regulation, and we're never going to have the states completely out of it, that we're going to have this power sharing, and it's going to be specific, and it's going to overlap, and it's just going to be the way of life until I don't know how long, but the next crisis, and then it'll change again. But thank you.
Great, Martin, thanks very much. So we're kind of getting this, I don't know if it's a milkshake or, you know, what kind of pastry we're looking at, but there are some insurance groups with IDIs who, assuming Tom and Dan can fend off the House bill, are going to have consolidated Fed oversight in all its glories with some sort of capital requirement. I assume it's going to be the building block kind of capital requirements that they've been talking about. But then there's some other, you know, large insurance groups that don't have IDIs who are going to be under the state system that Roy alluded to with a new model act that's going to be beefed up, but with Mike's covered agreements hanging over their heads that may be preempting them or not at some point down the road. We'll have to sort of see about that. But let me just turn, you know, first to Ted and then to Mike to get your kind of takes on this regulatory sharing system that seems to be emerging here.
Sure, thank you, and good morning, everyone. And I'm going to just maybe provide a little bit of some practical observations that I've seen over the last several years, and provide a little bit of context for, in response a little bit to some of Pat's, Dr. McCoy's comments before. I feel like I've been thrown under the bus from a couple of different sides here, so I just want a chance to respond. I need a hug. Thank you. No, I don't need milk. I'm lactose intolerant, so we don't want that. Too much information. Roll the tape. Yeah, there you go. So I just want to provide a little bit of, maybe a little bit of, I'm not the president of the NEIC anymore, but I still am a member, so I guess I'll provide some of my own thoughts, but some of the activities that are going on at the NEIC that really do address some of these items that we discussed this morning. And so I just want to maybe start out by saying, you know, as we critique FSOC, as we critique some of the things that occurred in Dodd-Frank, maybe they weren't elegant enough to get a perfect solution to a lot of the problems that were identified pre and post financial crisis. But I think the results are this. The companies that were deemed too big to fail, they decided to divest and get off the list. So is that helpful to folks? So that, you know, now they're not on the list anymore, but they're a completely different looking company than they were when they went on the list. You know, you've got my good friend Tom here, who is overseeing insurance companies that either own thrifts or thrifts that own insurance companies, and there's that Federal Reserve requirement to keep an eye on them, and I think that's great. But that's a choice. They made the choice to own a bank. They made the choice for whatever reason. And if that's their choice, that's how they roll. I know there are several insurance companies that didn't like Tom's Federal Reserve oversight, and they sold the bank. So they're good. And one company that actually moved they actually moved from a savings and loan to a credit union to get out from underneath, which has never been done before. They were rechartered back to a credit union just because they didn't like that oversight, and that's fine. That's what thoughtful people do to solve problems. I would just say that we've lived through a very, very difficult time, and I think we've all worked pretty well together. The Federal Reserve, the Federal Insurance Office, and Treasury. Got to spend Mike's entire career as FIO director with him, and we've had a disagreement or two along the way, but we've pretty much been aligned, and we want to make sure that solvency and consumer protection are utmost and important to us. And I think if we kind of look further down the line, and this is where I do have a bit of an argument with Dr. McCoy about, and these are my words, not hers, but there's a sense that states aren't sophisticated enough to deal with macroprudential threats or systemic threats. And I would argue that we as regulators, one, we do a pretty good job doing the solvency work that we do with regards to our own companies. We do identify issues. There are literally thousands, if not more, conversations that occur every day with companies by interested regulators about particular practices, investment policies. We know our companies very well, and we've probably been responsible for not seeing companies move toward a more perilous financial position, because we're on the ground, we're in the states, where the domestics are. We spend the time in the companies doing the work we need to do in the analysis to make sure that at the end of the day, they're meeting their financial solvency requirements, and they're protecting consumers. And so we do a pretty good job. But the U.S. system is designed to allow for some failure. We have a guarantee fund system in all 50 states that takes care of companies who fail. And it happens, but we're a risk-taking country. So we are so different from other countries that we allow a lot of risk to be taken, measured, regulated, with guardrails around it at times, but we allow risk to be taken, and there are occasional failures. And when there are those failures, the insurance industry itself steps up to the plate and takes care of those policyholders from failed companies. And that's just a fundamental difference of the United States system versus what you may see in other countries. And I think that's what makes us stand out. But with all of that said, the financial crisis was a game changer for us. And it was a game changer for Treasury, and Dodd-Frank, and the Federal Reserve. And we recognize now, probably did in the past, but we recognize now that there are, the world is getting more complicated. It's getting more interconnected. Financial transactions are becoming more sophisticated and more difficult to understand. We've got innovation and technology moving its way into the insurance space at a rate unseen before. And all of that causes state regulators to pucker up. We get worried about those things. But the good news with that is we've identified a lot of those issues. We've had Director Huff, we've had Commissioner Ham, and now we have Director Hart serving on FSOC. And they've all been, to the extent they can say things publicly, because a lot of what they do is guarded, but they've all identified that there are macroprudential risks facing the insurance system. And we need to identify those, and we need to be careful not to make mistakes moving forward. And so the NEIC, of which, again, I'm a member, and proud of the work I've done there, and hope it continues to do great work, is not your typical trade association. It's a regulatory support organization. It supports all 56 jurisdictions, and it provides resources for when us as relatively unsophisticated states don't have the resources to do the research or to better understand threats and opportunities facing the insurance regulatory environment. And to that end, we've just finished a strategic planning process, and we have identified, one, that innovation and technology is here to stay, and we need to work closely with companies who are bringing that level of information and technology into their systems, as well as recognizing the ever increasing threats we face and the opportunities we face working with our international colleagues on international capital standards, international regulatory developments, and again, these partnerships we have with the Federal Reserve and Treasury through FIO on those negotiations there. And to that end, the work of, or the framework laid out by the State of Head document and other work streams at the NEIC recognize the macroprudential oversight that and interest that we need to continue to engage in. And I'm very excited that Director Hart from New Jersey is leading that effort. And I'll just give you 4 of the areas that we're looking into or are trying to wrap our heads around. 1 is liquidity regulation. 2 is resolution and recovery. 3 are counterparty exposures. And 4 are capital stress testing. All 4 of those areas are very important to identifying potential systemic problems that may be posed by standalone insurance operations, whether they're parts of large groups or if they are a part of their, if they're a standalone. So we've identified systemic risk, and we're looking at it through our macroprudential initiative, and there'll be more to come on that, but what we haven't done pre and post or post financial crisis, we haven't stuck our heads in the sand and said we're just going to regulate at the state level. We're going to take care of consumer complaints, and we're going to move forward. That's block and tackling for us. That's what we do each and every day. But we do recognize that the world is becoming more interconnected, and we want to be engaged, and we want to be at the table, and we want to be upfront and understand those risks as we face them moving forward. I'll stop there, Howell, and I feel better now. Thank you.
That's good. And I hope you got the sort of psychic hug you were looking for. So, Mike, let me turn it over to you now. I'm definitely interested in how these issues look from your position at the FIO, and also what the future is, assuming that the Kill the FIO bill does not pass while we're sitting here.
First of all, good morning. Thank you, Daniel, for the opportunity, for the invitation. I think it was the earliest invitation I've ever received for a conference, maybe 10 or 12 months ago even, so thank you for that. And I did want to acknowledge my former colleague, Tom Sullivan, who does remind, I'm sure, all of us of Abraham Lincoln. And but the great thing with Tom is, even when he was wrong, he had a strong view. So I like that about him. And Ted, of course, is a wonderful guy, great guy, has done a great job at the NEIC. I was noticing the title of this event, by the way, Early Career Scholars. And I was remembering about a month ago being invited to a young professionals event. So no judgment on your age as an individual, but just as a group, I don't know how many of us are in our early careers. I don't even know what that means, but just an observation. So briefly, my view on the future of U.S. regulation, we will not have a federal regulator in the insurance sector. I have never thought that. I did not, as I testified 20 times in front of Congress, the first time in June of 2006, the last time of April of 2017, published 17 reports at the Federal Insurance Office. Every one of those supports the state system of insurance regulation for real reasons. Our country is a big country. Other countries, you could look around Europe, for example, it's appropriate that they only have one regulator for their country. Many of those countries are smaller than our states. But we have regional differences, climate differences. I do support the ACA and do think that every person is entitled to adequate health care, but the ACA supported state regulation. The ACA referred to the NEIC in the statute. The last two times I'm aware of anyone calling for a federal regulator was in Secretary Paulson's blueprint for regulatory reform that Martin alluded to earlier. That came out in March of 2008. The last time was in House Bill 1101, that came out last year, supporting association health plans the ultimate abnegation of state authority, by the way, and created a federal regulator in HHS to oversee the solvency of those association health plans. Those were both Republican initiatives, FYI. Now, the bottom line is, and Martin referred to the Paul versus Virginia case, the 1866 case, I'm sure all of you remember. New York life insurance companies in Virginia immediately after the Civil War collecting premiums for life insurance policies. The state of Virginia appropriately said, we need to know you're going to be here to pay when the person dies. So they established bond requirements for the New York agents. The agents sued, saying this is a violation of the Interstate Commerce Clause, and the Supreme Court declined to accept that argument, and that has now been the law of the country ever since, and it should remain that. The states have done, in my view, an excellent job at the local level of taking care of the people in those states, and when I think of my own family members who might have an insurance issue, I don't want them to have to call Washington. That has not changed. The states, as Ted alluded to, I completely support all the work that they've done with respect to group supervision. And I'll get into the covered agreement in a minute, but that's one reason why I was so adamant that in the covered agreement we track all of the current group supervisory practices at the state level. They're doing the right stuff. And what they do now is, what the states are doing is enhanced and far more sophisticated than what we were doing when I left in 2011. Financial stability, let me back up. I thought as a state regulator and thought as the FIO director that the best way to protect the state system, the best thing for our country, was for the federal government to provide help and to keep the state system, help limit the prospects for failure at the state level. That is my view today. I think the areas where there could be a failure are three areas. Financial stability, there's been discussion about that. International, it's inherent in our historical, legal, and constitutional system. Essay 42 of the Federalist Papers, written by James Madison, states' right, passionate, ardent states' right advocate, that if we are to be one country in any respect, it surely ought to be with respect to other countries. That's prior to the Constitution. So international, the third then would be areas of uniformity and efficiency, and we saw just a couple of years ago, NARAB, a federal solution to the administrative burden of getting a producer license in the country, and we have this totally contorted apparatus that requires the president to appoint 13 people to a board who are subject to Senate confirmation every 2 years. It'll never happen. The vetting process for a presidential appointment is so exhaustive that by the time somebody, half of them have to be commissioners, and they have to be from different parties. So by the time they're vetted, they're no longer commissioners, or they're on their way out, or it's a total contraption destined to fail. But it's a sign of where the federal government, the basic function, administrative, clerical aspect of licensing for agents required a federal solution. So let me talk for a second about financial stability. I have great respect and affection for Roy. That did not ever change through the time we served together on the Financial Stability Oversight Council. I disagreed with Roy. I disagreed with Roy this morning. I had forgotten some of these things. But I do want to congratulate Roy on a great term of service and his service to the country in that role. He raised important questions. He answered them, in my view, incorrectly. But he raised important questions. A couple things that I think are notable. I don't think we can support the designation. By the way, my office and we were involved in the analysis, the drafting, and I supported all three recommendations of for each of those firms. It's very difficult to say that we're okay designating a firm, AIG, that's primarily property and casualty, not economically correlated liabilities, that is 40 to 50% fewer assets overall than the two other firms that were designated, that are primarily life and annuity products with much greater potential for a runnable liability. Now, we can debate the merits of that, and I'm glad that Pat raised the prospect of the trial court's decision. While I have great respect for the judiciary, I practiced law 15 years before joining government. I litigated class actions around the country on behalf of financial institutions, was in the Chicago office of McGuire Woods, if some of you might know that firm. She was wrong. The judge was just flat out wrong, telling us that we needed to evaluate the likelihood of failure. The statute says, and Tom Glassick will remember this, he was involved with drafting it, Title I of Dodd-Frank says, assume material financial distress. It doesn't say evaluate the possibility or the likelihood. So good judges can make bad decisions, and I'm not going to comment on whether she's a good judge. Let me talk briefly about international, and then I'll stop, because I think we're at our limit or close to the limit. The FSB is not a regulator. It has no authority in the United States. There is no nexus between the FSB and the FSOC. That's a complete fiction. The FSOC is an independent, statutorily created organization that is governed by the laws of the United States. There is no law empowering the FSB or the IIS to do anything in the United States at all. Any international standard developed that's developed is implemented at the insurance sector level by the state regulators. It doesn't matter what the FSB says. It doesn't matter whether the Secretary of the Treasury supports everything the FSB has ever done and runs around naked screaming how much he loves it. It's still at the state level, up to the states how to implement and whether they implement. When I started at the Federal Insurance Office, and I see Dave Snyder over here, and he'll remember this, I traveled around the world for about 14 months, and I listened to everybody. People our country liked and didn't like. People we agreed with and didn't agree with. First trip was to the States, by the way, Des Moines. Ted, I don't know if you were there, but my first trip at the Federal Insurance Office was to Des Moines, Iowa, to meet with the insurance commissioners, and then I traveled and I listened to everybody. And what I learned was these countries don't play. This is not checkers. You can't show up at an IIS meeting or an international meeting with talking points. You have to know the subject matter better than anybody else in that room if you want to have a chance. The people the other countries put forward are like Federal Reserve employees. They are at the highest level of their profession. It is the apex of their careers to serve in the international roles. And we had to match that. So we were successful, and we were successful because we took my first boss, Secretary Geithner's challenge, when he said, you're paid at federal employee levels, you're not going to have any of the resources, you're going to be flying coach all over the place, but you have to know everything else better than anybody else. And that is exactly what we did. So we worked with Ted's colleagues at the state. It was great to have Tom and see him build a great team, Matt Walker, Suyash. And what the United States did with that team was lead the conversation. That's exactly what we did, and that's what we should do. The United States should not be in isolation developing a standard on its own and then hoping that the world approves. That's not leadership. Leadership is saying there's going to be an international standard, and it's going to integrate the U.S. approach, whether those other countries like it or not. And to do that, we had to push, and sometimes that put us in conflict with the states, but no one can challenge the merits of the work that we did and the fact that the U.S., the United States, the Treasury Department, the Federal Reserve, and the state regulators led the conversation. And I'm not sure how things are operating right now. Good people are still engaged, and my hope is that continues. But to lead in that international conversation, to ensure that our multinational companies are treated fairly overseas, it requires institutions with decades of experience and exposure to the other financial leaders in other countries. So the insurance sector should not accept this as, it's not a criticism of the states to say that the Federal Reserve and the Treasury are the two leading financial public sector, leading finance ministry, leading central bank in the world. It's good for our insurance sector in the United States to have them leading that conversation with the states, not exclusive of the states. Final thought, it is the importance of the state regulators that forced us, not forced, that is the reason why I personally engaged in rather heated conversations with other members of the executive branch, so that when we negotiated the covered agreement, there was a state regulator in the room for every negotiation. So they saw and reviewed every document we sent out before we sent it out, everything that we received when we received it. There were 9 or 10 state regulators involved in that process. That has never before happened in United States history, and the reason is very simple. It's, as lawyers, you can appreciate this. What state do you choose? And if you're going to choose an appointed state regulator, what if a governor wants to get in? What if a member of Congress wants to get in? Those of you who have served on the Hill can appreciate the complexity of this. But we created a mechanism to include the states out of support for the state system and respect for the individuals who are involved. And it's because of their involvement and the involvement of Suyash and Tom and his team that the covered agreement was such a successful effort as well. I'll stop there, sorry.
So Mike, just one thing about the covered agreement and its relationship to state law. It depends on the area, but let's take reinsurance. I mean, my understanding is where you ended up in reinsurance is going to move state crediting systems over the next few years. So you didn't just impose the U.S. model. You went to a model that kind of was pushed from the other side, at least as I understand it.
So I say this with great respect and affection, but that's a misunderstanding.
Well, that's what I'm here for.
So let me say this. So one thing that had happened, many of you will know, the NAIC had moved to revise U.S. state reinsurance model laws with no reciprocal benefit. The covered agreement says the terms that apply to EU reinsurers in the U.S. now apply to U.S. reinsurers in the EU. So there's a quid pro quo that never existed before. Second part, there were 31 companies, reinsurers, that had received relief under the NAIC model law that we could that we publicly could research. 30 of those were posting 10 or 20% of the collateral they had posted years before. So it wasn't going from 100 to 0. It was 10 or 20% to 0. Thirdly, all of those factors that are in the covered agreement that entitle a reinsurer to collateral relief, not entitle, that entitle a regulator to say the reinsurer can have collateral relief, those were based on what are called considerations in the NAIC model law. We heightened the consumer protection by saying they're no longer just considerations. These are factors. They have to be satisfied in order for collateral relief to be provided. But does it change how things have been? Yes.
Yes, and we do have to take a new look at our existing collateral and group capital, or group supervision laws to make sure that, reinsurance and group supervision laws to make sure that the elements of the covered agreement are operationalized, and we're in the process right now of trying to figure out if we're going to do it just for the, just for the bespoke EU piece of it, or if we're going to do it on more of a global basis, and we're still in the middle of those discussions right now.
Interesting. So, Dan, since this is your conference and you're on the panel here, let me give it to you both to pose, react, respond, agree, disagree, and also to tell us how much longer we have.
Well, we have 13 more minutes, and I actually think it would be nice to open it up to the audience to ask questions. We haven't really had much of a chance for that, so I will call on people. So we'll start over here and move our way around. And as you suggested, started from Bipartisan Policy Center. So I know almost all of you, but you should also say who you are too.
Thanks for the great panel. Appreciate it. Roy brought up international discussions, and Mike did, and that's come up with several times here. And we've also talked about legislation that's pending, and there's another piece of legislation, which is the main Senate banking bill that's gotten a lot of coverage for what it does to bank regulation, because that's what it focuses on. But it also has a Heller-Tester provision on international work with basically trying to increase the voice of states in international insurance negotiations. And a portion of the bill says that basically when there's going to be an international position taken by the Treasury, the Fed, and FIO, that it says that those three bodies shall achieve consensus positions with the state insurance regulators through the NAIC. Now, I haven't heard this get much coverage. Maybe I haven't been reading the right sources. But the way I read that is that the NAIC could effectively block or veto a position in that group. And maybe any of the four actors, maybe the Federals, could do the same thing. Am I reading that incorrectly? And if so, I mean, how do you think that would impact international negotiations?
The other point to mention is the DOJ, the Office of Legal Counsel, just a few days ago, maybe a week ago, came out, and I think Suyash was presenting this to me, with an opinion that that portion of the bill may be unconstitutional. Well, I'll bring it to Mike because he seems to have strong views on it.
I love the fact that some members of Congress are so pro-state that they decide that an appointed official in state government is now all of a sudden developing foreign policy for the United States without deciding whether the governor should have a role or the legislature. Apparently, the 10th Amendment only matters when it is supportive of your view, because it's completely unconstitutional. I will also say, though, and this is just mildly entertaining anecdote, we had this debate, what does the word consensus mean, at the IIS. Tom Sullivan will remember this, because there were times in all this palaver that, we were so agreeable with the Europeans. Ted will remember this as well. There were times when we were the only country in opposition to a view. And by the way, the European Union, each of those countries is a separate member. And we have a principle at the IIS that we have to achieve consensus, or the FSB does. And so we refused, and others said, well, we can still have consensus even with one dissenter. And so we looked up what does the word consensus mean, and again, it depends on your point of view. But I would say you could get consensus with 2 out of 3. In this case.
If it's constitutional. So other folks from the audience. Let's see. Baird?
Yeah, I'm Baird Wable at the Congressional Research Service. I first just would be remiss in not thanking Roy for all of his guidance over the years, and I've really just tried to do things as well as he did before me. The question that I sort of had was, when Tom was talking about HR 5059 and how the Fed is sort of overseeing savings and loan holding companies and some of the controversy about it, I was curious, sort of internal to the Fed and how it's doing things, because listening to the people at the hearing, there seemed to be a question of how well the examiners and the people actually on the ground were being overly bank-centric compared to perhaps with your group at the board level. So I was curious, from an internal perspective, what kind of interactions do you have with the people that are going out on the ground and the like, actually overseeing these companies?
I mentioned in my remarks the energy that's gone into the sharing. I think it's a question of, I don't think you can ever do too much in this regard, right? So I think it's really a matter of calibration. I'd give you some anecdotal examples, though. By the way, when we do examinations, we take discrete elements of looking at risk across the enterprise and segment them into specific exams. So for instance, we can do an examination on liquidity. We can do an examination on risk management. So we take certain aspects of how the firm operates, governance, and we look and we do an examination on that discrete topic. Let me touch on what we do on an examination of risk management as an example. Before we engage, before we go out and do a risk management examination, we meet first with the state DOI, actually have in our hand, through our sharing arrangements, a copy of their last ORSA report, which is, for those of you who don't know, it's the Own Risk Solvency Assessment. We have that in our hand. We sit down with the exam team that conducted the risk management review of that enterprise, and before we even visit or go out to the insured institution, we share with our state colleagues and understand what they did. So before we go out and engage, we don't duplicate all the work that they had done through their ORSA process. So, is it perfect? No. But there's an example of, the lengths that we go to ensure that we don't bump into each other and we don't duplicate efforts with the impacted firms. Again, is it perfect? No. There's going to be some overlap. There's going to be some duplication. I don't want to go so far as to say, if you don't like it, sell your bank. I don't think that's the right answer either. On the other hand, there is a certain price of admission to having FDIC insurance over your bank institution. And what you do what 5059 prescribes, I just worry deeply that just is Pandora's box and everybody will be knocking at our door, the next one, and you've created another arbitrage loophole for anyone else to run through. I just think that door could get kicked down real easily. So can we get better at the supervision? Yeah. And we're working really hard at it. It's not perfect yet, but we're working at it really hard.
Jeremy Kress, University of Michigan Business School. First comment and then a question. On SIFI designation standards, I think in addition to asking the question that Pat asked about, is it possible for FSOC to do this analysis, and the question that Mike asked, is it legally required that FSOC do this analysis? I think we should also be asking, is it a good idea as a policy matter? I worry that if FSOC is only designating firms it deems as vulnerable to distress, that's a pretty quick way to start a run, and we might be enhancing vulnerability rather than decreasing it. If that's the standard that FSOC uses, I think that because that was one of the grounds on which Judge Collier overturned MetLife's designation, it's become an infatuation of policymakers who are antagonistic towards designations, and I think it's worth evaluating whether, as a policy matter, it's a good idea. Question, I think for Tom, but I could open it to anybody. Tom talked a lot about reducing opportunities for regulatory arbitrage with the ISLHCs. Ted mentioned there was one firm that converted its thrift to a credit union. I wonder about reviving another opportunity for regulatory arbitrage. The incoming chair of the FDIC has signaled her interest in reviving the industrial loan company charter. Do you think that any of the ILHC population would be interested in obtaining an ILC, converting to an ILC if she starts handing those charters back out? Is that something you worry about?
You know, I don't know if I'd go so far as to say worry about could they, I'm sure there's some that would evaluate it. When you look at that very small, by the way, cohort, 11 firms that own a bank that's a FDIC-insured bank, they are really diverse. Some do auto origination loans. Some are full-scale commercial, banking enterprises, and they range in size from 70 billion in assets down to, very small banks. So, again, even in that small sample size of 11 firms, there's pretty good diversity. So I suppose it would it's going to be a proposition they look at through the lens of what's the purpose of our bank, where would we put it, et cetera. So I hate to speculate on that, but it could happen.
Just briefly, I would say on the first point, that's a straw man argument. The purpose of a non-bank SIFI designation is to then have the institution undergo heightened prudential regulation to de-risk. And actually, probably something Ted and I agree on is ultimately, I think it's a good idea that there be a de-risking off-ramp to encourage companies that have been designated to de-risk to the point that they no longer present a credible risk of runs. And so that designation process is the vehicle for accomplishing that.